first half.
Rich, what about from a sector standpoint? We can take tech first. Obviously, given your movement within your portfolio, you don't believe that tech's going to do well in the new year. You trimmed Apple for the first time ever a couple of months ago, and you sold Amazon in September.
Well, we had to lighten up on tech because of our overall thoughts on the market. But to Jim's point, you take a company like Microsoft, their free cash flow since 2019 has gone from 30 to 61 billion. You've got Apple's free cash flow going from 60 to 110 billion over the last 3 years. And all these companies are simply executing and increasing their free cash flows. That's after very, very large amounts of CapEx. So at some point, these companies, everyone's going to puke them out, and they're going to get very valuable on a multiple of cash flow. Right now, that multiple of cash flow is averaging anywhere from 4 to 6%. So I'm not as negative on the tech sector as it might appear. I just was so overweight, I had to trim it out.
But what do you think of Jim's overall view? I ask you because I don't know of two people who have been on this show together at the same time. I mean, Weiss obviously has been extraordinarily negative for a while on the market, and he's been correct. But you've got more cash for the most part than you ever have. You've been a batten down the hatches guy for months. Your view is decidedly negative on what lies ahead. And you just heard Jim articulate the reasons why he believes that none of that's going to come to fruition. He doesn't believe in a recession. He barely believes in an economic slowdown.
Well, clients at Treasury Partners have made copious amounts of money in the stock market over the last several decades. And we get to choose when we're going to put money to work. And this is an environment where the landscape is dramatically changing from the last 15 years of a zero interest rate environment where everything went up to going forward where we have a higher structural interest rate, which increases the discount rate for future earnings and is going to put more pressure on choosing the right stocks. At the same time, there's tremendous opportunities for our clients where we asset allocate in the bond markets. So I don't have to only focus on one asset class, which is the stock market. We're very comfortable now reducing our exposure and owning bonds, which have done exceptionally well since we started putting them on in September.